Hi, thank you for coming to our channel. In this video, we're going to have a look at these free trade brokers like Robinhood, Trading 212, Etoro, just to name a few. These new platforms are disrupting the traditional marketplace that usually charge for their trading services. So, do they make sense? Should you use them? How do they make money? Keep watching and we'll find out. I'm Anthony and we're talking money. In the past, if you wanted to buy shares, you either phoned up a broker, yes, I still remember those days, gosh, or you went on a traditional banking platform like Barclays or HSBC and bought a share like BP or National Grid and paid them a broker fee, in addition to stamp duty and probably an annual fee as well for having the account in the first place. Fees either range from, say, £5 to £12 a trade or a percentage, and that was it. Also, if you wanted to invest in something like Amazon, then you would have to spend at least $3,200 because that's just what one Amazon share is worth. If you wanted to invest just £100 in Amazon, then you just couldn't do it. And then came a new choice. As with most new and shiny things in technology, it started in America, and in this case it was a company called Robinhood in 2013. It introduced a no-fee brokerage and has grown so fast that it now has over $20 billion under management. In the UK, we have companies like Freetrade, Trading 212 and Etoro, and their platforms have exploded in popularity too, partly I suspect because of the lockdown giving more people a chance to investigate share dealing and things like that. The appeal is obvious in that you don't have to pay to trade. And remember that Amazon share costing $3,200? Well, now you can invest in that too, because these free platforms allow what are called fractional purchasing. They allow you to buy a fraction of one share rather than the complete one. So what's not to like? It seems that they have everything covered. Surely traditional brokers like Hargreaves Lansdown and Barclays stockbrokers are finished, right? Well, not so fast. These new disruptors have to make money somehow. They commonly charge a monthly subscription fee, not dissimilar to the Netflix model. There are free options, but they're fairly basic. And if you wanted things like an ISA portfolio where you can put all your investments inside a tax wrapper, or have additional add-ons like having stop loss limits, which are really important, then they charge for these services. So aside from their free basic service, if you wanted an ISA, Freetrade, for example, charge £3 a month, and to have those additional add-on services, they charge £10 or $9.99 a month. Trading 212 said it plans to grow its freemium model, which means that very basic services will be offered for free, but any add-ons, which seem pretty essential to some, will be charged on a subscription basis. But if you have a relatively low amount to invest, say £500, and you're wanting to put it into an ISA savings account, then that £3 a month fee is essentially a 7.2% annual charge on your money. That's not a problem if your investment grows by more than that, but it is quite an obstacle, even on a moderate gain. They also charge for some of their services such as buying foreign currencies or shares, even if you are on the basic subscription model. They may also lend out your money to other people and act a little bit like a bank. This practice may sit a little uneasy with some people, but may be fine with others. After all, that's exactly what your high street bank does when you deposit your money in your own account. The next way some of these free commission companies make up for lost income is to widen the spread prices on offer. Put simply, they widen the gap between the buying price and the selling price. To give you an example, if I wanted to buy Glaxo shares, currently about £14, on Hargreaves Lansdown, the difference in buying and selling price is just 0.04%. On free platforms, the spread can be as high as 0.9%, even though the average is a bit lower, nearer perhaps 0.2, 0.3%. All that means is essentially you pay a little bit more when you buy and you receive a little bit less when you sell. One area that these free platforms can save money also is the amount of information that's available to you before you buy. Research and analysis costs money, and free platforms are somewhat sparing in the information that they provide on shares. Compared to Hargreaves Lansdown, for example, I'm not being paid by them, by the way, they have brokers' forecasts, financial records, director deals, just to name a few. One of the more controversial ways that some free platforms make money, and this is more so in America rather than the UK, is by using a practice called payments for order flow. In financial markets, payments for order flow refers to the compensation that the free commission broker receives, not from you, but from a third party that wants to influence how the broker routes clients' orders to fulfillment. It has been controversial in the past, and it's called basically a kickback. It's common practice in America, but as I say, it's illegal here in the UK. This essentially means that lots of smaller trades may be bundled together to keep costs lower, and it does mean that the company executing the customer's trade may get prior knowledge of a forthcoming trade before it actually happens. This can lead to a conflict of interest, since profit can be made by buying the shares at a slightly lower price moments before selling those shares on to you as a new buyer, a system known as really arbitrage or scalping. Now, any of these may not actually matter, but in my humble opinion, the following scenarios should make you a little wary. By not having any commission fee, it's a bit more tempting to trade more often. In fact, day traders particularly attracted to commission-free platforms, as they may be executing dozens of trades, if not hundreds, every day. But this can invite risky trading, and one of the main criticisms of free platforms is it gamifies investing and muddies the division between investing and gambling. After all, if there's no upfront cost in doing a share trade, one is more tempted to actually do it spontaneously without due consideration or thought beforehand. Next, if you have a relatively small portfolio of say £5,000 and want to put it into an ISA tax wrapper, which is always a good idea by the way, the monthly fee and the wider spreads on your trades may actually erode any savings that you make on having a commission-free trade. So I would take a look at several platforms, make a note of the different monthly fees and costs, buying and selling costs and things like that, and remember that if you intend only to make a few trades a year, say less than a dozen or so, then the fees are not going to be that great anyway if you do have to pay for buying and selling. I put in the description below a list of common brokers and their fees so that you can compare. On balance though, so long as you know the disadvantages and most importantly invest with sensible expectations, set stop loss limits and put money in that you can only spare for the long term without the need to touch it, then these free platforms may be worth a look at. Certainly in the UK, Freetrade and Trading 212 are good examples. If you wanted a traditional platform for larger portfolios, then I personally recommend Hargreaves Lansdown. I'm not being paid at all from them, I'm not employed by them or anything, I'm not getting a penny just by saying that I think they're good. They're the company I personally use. They have a lot more choice on the shares that they offer and lots of funds available as well, and a lot more analysis and research than is available on say the free commission sites. Anyway, let me know if you have experience with these free commission brokers or if you prefer the traditional platforms. I hope you've enjoyed the video. Anyway, if so, please hit the subscribe button and the notification bell, and I'll see you in the next one. Anyway, I'm Anthony, and as always, we're talking money. Bye for now.